Peak Wealth Management proudly presents the Trust the Plan podcast with Nick Hopwood and Jim Pilot, where we believe by providing education and guidance, we can help you retire with peak confidence. Now, here are your certified financial planners, Nick and Jim.
Welcome everyone to the Trust the Plan podcast. I'm Nick.
And I'm Preston.
Preston, that's a nice new Peak polo you got there. Penguin, huh?
Yeah, the whole Peak staff got this new swag.
Looks breathable and everything.
Yeah, I love it.
Looks good. All right, today we're talking about private investments in your 401. So what does this mean, private investments?
Yeah, it can be, just in general, the term means investments that aren't openly accessible to everyone on the market. But examples would be like private equity, private credit, private real estate.
So they're not traded. So there's some illiquidity.
Right.
Okay. And illiquidity means, by comparison, a stock or a mutual fund or an ETF, when you press the sell order, it's either selling immediately or later today. So
Right.
Daily liquidity. Illiquidity, maybe it's a monthly liquidity or quarterly liquidity. And that means if today's, the 15th of the month, I can't sell until the 1st of the next month.
Right. Or sometimes it's even the first of the next month if it's quarterly.
That's right. And so how would this work with 401s, with illiquid investments, and why would we want to do this? So first of all, what worries me is that someone looks at some historical returns and says, oh, this fund or this interval fund or this program looks really great. It's got great track record. I'm going to put all my money into that, right? We see people doing that with their 401s, which scares me. But then what happens if they put all their money in this illiquid investment? Well, that would be a big problem.
Right, because, the illiquidity problem is, it's obvious, right? If you ever need to take money out, you're not going to be able to get it out as soon as you need it. But the second part is there are examples where, on the quarter you go to redeem your investment and this investment company says we can only honor 60%, 70%. And so you didn't actually get all your money out.
Yeah, that can happen. That's one of the risks. So if you put all your money in something like this and it's locked up and there's a run on the bank, so to speak, and they can't redeem all the money, well, you just compounded your problem. So
Right.
Here's how I think it's going to work. So there's big companies like Empower, one of the largest 401k providers. They seem to be probably first to market here. And what they're doing is they're creating an investment model where you have to subscribe to their recommended program in order to get the private investments. And then they will limit how much you can put in. And I would guess if you're super aggressive, for compliance reasons, the max would be 20%. Okay, so that's what we see across the industry. And so you subscribe through the Empower Managed program. I'm not sure how much that will cost. And then you kind of turn it over to them. Okay, so you're no longer making your investment choices. Kind of like if your IRA were with us, you're hiring Empower as your manager, and they're allocating to the private investments. So I would suspect what they're going to roll out are some private credit funds, private real estate funds, maybe private equity, and these are the most common, the most popular programs. So we've been doing this for years, right? For over 10 years with real estate and private credit and private equity. And so the difference is it was never allowed in 401k plans before. And I also expect this is going to be rolled out very slowly because the administrator of your 401, it's a partnership between Empower, but also the company itself. So in the Peak Wealth Management 401k, we create a lineup of funds in your company, whether it's, say, Ford or GM or any company under the sun. They are providing the lineup. Okay, they are going to have to agree that they want to allow these investments for their employees.
Right.
So that's going to be a slow motion rollout as well.
Yeah. And one other thought that I just have about this is I would hope as part of the rollout there's some sort of education about exactly what all these funds entail before you're able to sign up. Because like you mentioned, they're going to have to hire the Empower manager, which is going to have a fee. Odds are these programs are going to have a higher expense ratio, which is something that's worth noting. And I would hope the average Joe managing their own 401k gets that knowledge before they.
Good point. Yep, that's a good point. So let's do some education here. Why would we want these illiquid investments? Well, some people make the case a retail investor is their own worst enemy. When, we have a tariff tantrum or we have a COVID event, whatever, recession scare, interest rates going up and the market, crashes, so to speak, a lot of people try and push the eject button. We help people with their emotions during those times, but when there's a 401 and you log right in and you're in charge, people tend to be more active than they would if they have an advisor, and the advisor can help manage that account in the bad times. Well, they're logging in, they're making emotional decisions, okay? And when you can't sell, it prohibits you from making that bad decision.
Right.
So that lockup, in essence, protects you from yourself. Okay,
Yep.
So that's one thing. It's to me, I guess, right? I'm not sold on that point. Here's where I believe the private investments add their value, and it's with diversification, right? If we look at the U.S. market, mutual funds, ETFs, stocks, what have you, the investable universe is mostly these blue chip companies, right? And there's mid caps and small caps and everything, but it's actually not the largest part of the U.S. economy, because we have thousands of small and mid-sized companies, and even the unicorns now, the big ones, that are staying private for longer. So like in the 80s, there were way more public companies than there are now. So by not having any of these private investments, we're actually not able to invest in the largest part of the U.S. economy. Okay?
Right.
So I like that.
Yep.
And then also, we're talking about diversifying by offering low correlation. And so real estate is a low correlation to stocks and a low correlation to bonds. The private credit, which is a form of more aggressive bond, actually has low correlation to stocks and bonds as well, interestingly. Mm-hmm. And private equity is the same way. So the goal is diversification, and the way that we get to the diversification is through low correlation. And these products, these asset classes, it's what they offer, low correlation. So I think it's nice based on diversification. The next thing I want to bring up here is this Wall Street Journal article from last week talking about how it's the worst idea in the world, okay? And so it's clickbait, right? Yep. But what they did, what the author of the article pointed out, were like two of the worst private credit funds that are out there, okay?
Yeah.
So they cherry picked some crappy funds, yeah, right? And basically said, this is a very bad idea. You should avoid this. But here's just a couple examples here with a couple of private credit funds that we like, that we use, compared to regular old bonds, okay? Mm-hmm. So over the last 5 years, the regular bond index returned, on average, negative 3.6% per year. This is backwards looking, okay? We actually like regular bonds going forward because interest rates are up now. But looking backwards, it was a real struggle since interest rates were going up. Now, these other two funds that we've been using, because we didn't like regular bonds for a while there, the 5-year returns were 7.8% per year and 9.2% per year. And so you compare, basically, let's just say 8% to negative 3%, we're talking about a huge value add here.
Yeah, absolutely.
Huge value add. And so, all private credit funds are not created equal.
Right.
Right? So you can cherry pick the good ones or cherry pick the bad ones. There's better ones out there, backwards looking, than what we have, but these are the real life ones. This is the real life example. Now, in all fairness, the private credit funds that we use are more aggressive than the traditional bond index. But what about the junk bond index, right? The most aggressive type of bond you can buy on the public market, right? That 5-year number is 5.2% per year, again, compared to about 8 or 9% per year for 5 years. It's still a pretty big difference.
Yeah, absolutely.
So ultimately, these private credit funds have done a great job, and it doesn't necessarily mean it's going to continue in the same fashion, right? Past results, disclosure, right? And I'm not offering any specific advice here, but I think it's interesting, and I think you're going to see more and more of these programs inside 401s, kind of like a Roth 401. The tax laws changed, it became available, but it was a really slow burn to get everyone involved.
Right.
I think that's how we're going to see it here.
Yeah, I agree.
Okay, so if you have questions about private investments, private equity, private credit, private real estate, we can offer you advice. Reach out to us at peakwm.com.
Peak Wealth Management thanks you for watching and listening to the Trust the Plan podcast, featuring certified financial planners Nick Hopwood and Jim Pilot. If you enjoyed our program, please subscribe and share. If you'd like to learn more about our services, please visit peakwm.com. peakwm.com today. See you next week.